Right, so let's look at the additional information. The first section of the additional information all relates to my acquisition date, and it provides information that I need under the acquisition method. It tells me that the accounting policies of the two companies are identical, so there's no adjustments necessary. Then on acquisition date, the identifiable assets and liabilities of the subsidiary were fairly valued. That is coming through in chapter 7, where we will look at scenarios where that's not the case. But for now, we assume the assets and liabilities are fairly valued, so the equity at acquisition date of the subsidiary is an indicator of the fair value of the business of S at acquisition date. Then they give you the retained earnings of P and S at acquisition date, and you specifically need this retained earnings of S as part of the at acquisition equity. Then the measurement of NCI is by the parent. The parent have decided to measure this non-controlling interest of this group at a fair value of 50,000 Rand. Then they just tell you to assume that each share has one voting right. And that's just an indicator that we do have control because we have a 70% interest by the parent. It is P Limited's accounting policy to account for investments in subsidiaries at cost in its separate financial statements. This is also part of your at acquisition information that you need, because you eliminate the investment by the parent against the equity of the subsidiary at the cost of that investment, the original consideration. Now, in the separate financial statements of the parent, we saw the amount for that investment, and because it's measured at cost, it remains at cost in the trial balance of the parent, so that gives you the consideration paid by the parent. The reason we talk about it now is you've seen in your first year that we have investments in shares measured at fair value, and then you have an annual fair value adjustment to that investment in shares. Now, under the investment in subsidiary, IAS 27, which deals with the separate financial statements of the parent, there is the option for the parent to measure an investment in a subsidiary at cost. And that option, as an accounting policy, is only available where you have an investment in a subsidiary. You do not have to measure an investment in the shares of a subsidiary at fair value. So that's what this bullet is all about. It's at cost, so that amount in the trial balance of the parent represents the consideration paid for this investment. Then they tell you that the share capital of the parent and the subsidiary has remained unchanged. So I can then assume that the share capital in the trial balance was also the share capital at acquisition date of the subsidiary. Now the rest of the bullets down here all looks at additional information for the intra-group transactions. Since 1 April 20X9, that happened in the previous reporting period. S Limited rents equipment from P Limited at a monthly fee of 3,000 Rand. And the rest of the information just tells you that it was recognized as an income and expense by the two companies. Now, this transaction was entered into in the prior year. Remember, in the current year, we saw an amount of 36,000 Rand for rent expense and rent income. This now confirms that that is intra-group. And it's the 36,000 is because it's 3,000 Rand per month for the full current reporting period 2010. That gives me that 36,000 Rand on the trial balance, and now I can conclude that that is an intra-group transaction. Then here's the information about the loan. P Limited granted the loan to S Limited on 1 July 20X10. Now that happened in the current reporting period. This loan bears interest at a market-related interest rate of 10% per annum and is repayable on 30 June 20x11. So the full balance is still outstanding. Remember, we have to answer that question whether it's still outstanding. So the balance will have to eliminate, and the finance cost and finance income will have to eliminate as well. Because the loan was only entered into in the half of the current reporting period, the interest is calculated as the 50,000 loan multiplied by 10% interest for 6 months, and that gives you the 2,500 that you see on the trial balance. So again, this information confirms that the 2,500 interest income and interest expense is intragroup. Then we see that there's an administrative management fee paid by S2P from acquisition date at 1,000 Rand per month. So that is 1,000 Rand per month for 12 months, the entire year. So that 12,000 Rand administrative fees received in the trial balance of the parent is an intragroup income. Then P Limited and S Limited's bank accounts are at different financial institutions. Immediately, we do not even meet the first criteria for offsetting these balances. So we will not be offsetting the favorable and unfavorable bank balances in the consolidated SFP.